This is a Laneway house.
And this is a Laneway house.
This is also a Laneway house. And this beauty right here, Laneway Suite. And they've been popping up all over my neighborhood in Leslieville, Toronto for good reason.
They help to enhance much needed affordable rental housing in the city. They create density, they use existing infrastructure, and most importantly, they help to animate underused urban spaces like this laneway. Over the past couple of years, municipalities have been introducing new bylaws to make it easier to build garden suites and laneway suites. And on January 15th, 2025, new and exciting mortgage rules have been introduced to make it easier and more affordable than ever to finance the construction of these beautiful suites. In the 2024 budget, the federal government announced meaningful changes to mortgage refinance rules that are designed to encourage densification and enable homeowners to add more units to their home by permitting refinances. The change will allow borrowers to access financing up to 90% of the value of their home, including the value added by the secondary suite, and amortize the refinance mortgage over a 30-year period. The new rules are an absolute game changer because usually the government introduces new mortgage rules and it's all fluff. But this time, there's an actual possibility to do something with these new rules, and here's why. Construction financing is not something that banks regularly provide, and so usually borrowers have to go to the secondary market to get construction financing from specialty construction mortgage lenders, and that's expensive. Not to mention that for construction financing, usually you can only get about 75% of the end value of the property. With the latest announcement that comes into effect on January 15th, essentially the government is saying, hey, bank, you can use our Crown Corporation CMHC to provide insurance on these loans, which now changes the playing field for the bank. They'll be a lot more interested to take on the risk because it's being insured by the government, and that effectively allows borrowers who want to participate in this access to really cheap capital, not to mention that they can now get up to 90% of the end value of the property.
To get a better understanding of how this refinance program works, let's take a look at an example representing the maximum threshold the program will support, which is for a $2 million as complete value. Let's assume you currently own a home in downtown Toronto worth $1.4 million with an outstanding mortgage balance of $1 million. Working with your contractor, you come up with plans to add a secondary suite, which will cost roughly $750,000 to complete. We then go to your mortgage lender, and the lender will ask an appraiser to evaluate the property and make an assumption about the as complete value, which assumes that the work on the secondary suite is already completed to date. The appraiser confirms that the as complete value of your home will be $2 million with the secondary suite. Using this new secondary suite refinance program, the lender can approve you for up to 90% of the as completed value, which is $1.8 million. Now, you have an existing mortgage of $1 million, so the $800,000 of additional financing will effectively provide you with enough budget to cover your $750,000 of construction cost. It's worth noting at this point that as a borrower, you will incur an additional expense of the mortgage default insurance premium, which will be added to your mortgage. In this example, the premium is 3.1% of the mortgage amount, which is approximately $55,000. There's also an out-of-pocket expense of 8% PST on the premium, which is approximately $4,400.
Now, if you want to take advantage of the program, there are some rules and some restrictions that you should be aware of. So number one, you must already own this property. You have to keep in mind this is a refinance program for secondary suites, not a purchase program. So you must be already the owner of the property. Number two, the property must be owner occupied or occupied by a close relative of the owner of the property. Okay. Number three, can't be used for short-term rental. So sorry, Airbnb is not going to be an option here. Now, how they enforce that, I'm not quite sure, but they're going to want to make sure that it is an actual unit that's going to go back into the rental pool to deal with long-term rental. The units must be self-contained, so basement with a separate entrance, laneway house, and it must meet municipal zoning requirements. A maximum number of units for the project can be no more than 4, including the existing unit. So that means that we can only do 4plexes. Okay, so if it's a laneway house plus 3 units in the main building, that's acceptable. Now, this one's really important. The
the maximum property value limit, the as improved value eligible for residential property against which the loan is secured must be less than $2 million. And I think that's a little bit of a tight cap on it, because in Toronto, if you're building a fourplex with a laneway house, I'm going to guess that it's going to exceed $2 million very easily. So that's a little bit of a mistake, I think, on the policy. We'll see if they expand that even further. Maximum loan to value up to 90% of the property value, including the value added by the secondary suite in combination with any other loans secured against the property. And then lastly, you are permitted to amortize the mortgage over 30 years. If you found any of the information up until this point to be helpful, please consider subscribing to my YouTube channel or follow me on Instagram or LinkedIn.
My name is Chris Mulder. I am a Toronto mortgage broker and a local Leslieviller. If you'd like to connect with me to discuss how to finance your laneway suite or any other construction or renovation project for that matter, I'm just a phone call or an email away. Till next time, bye for now.